Please welcome the panel on Global Macro Outlook, Converging from Divergence, moderated by anchor of Wall Street Week at Bloomberg, David Westin.
Okay, welcome everyone. Thank you so much for being here. And thank you, panelists. We've got 4 distinguished CIOs here who are going to tell us how to invest our money, right? Or at least how you invest your money. So thank you so much. It's an unusual title, at least for me, Converging from Divergence. So we'll try to make some sense out of all that. Rohit, let me start with you. I mean, at Temasek, you've come the farthest, so you should get to start, it seems to me, coming all the way from Singapore. There's a lot of talk about divergence generally across the globe, in economies but beyond economies, as we move from maybe a post-World War II environment dominated by the United States with a lot of institutions. As you look at the world, how much of divergence is there, and what are the ones that matter to you as an investor?
Well, the divergence is across a number of different areas. There's economic policy, there's monetary policy. But for investors like us that are looking at about 80% of our portfolio is illiquid. So we need to look at 3 to 5 year horizons in terms of making our investments. And I think probably the most important area which we're focused on right now is geopolitics. And the reason is that unlike any time in the past, I mean, today it's leading to economic fragmentation because of a move away from multilateralism into nationalism and protectionism, all in the name of security. And that is actually leading to a lot of implications for us in terms of how we invest. So for example, as you have more and more trade restrictions, capital restrictions, technology flow restrictions, it becomes important to invest in companies that have access to large domestic markets and ones that are relatively self-sufficient within a particular political bloc or economic sphere of influence in terms of supply chains, technology, etc. So examples of that would be most services business in the US, cloud computing platforms, healthcare services in India, domestic brands in China. These businesses in the geopolitical world we're talking about are likely to be more resilient over the next few years. Then the other thing is, of course, you're going to see structurally high inflation because, again, with this protectionism and national security issues, you're having redundancy of supply chains in higher cost locations. And you therefore need to invest in companies with higher pricing power. And fundamentally, you need to have a part of your portfolio that's aligned to an environment of high inflation. Very different from the last decade, where everything that actually, most sectors did well were those that benefited from low inflation. So you've got to keep that in mind. And then lastly, I would say governments are, there's so much industrial policy support by governments, again, in terms of promoting internal security and things like that, that you again have an issue where there will be more and more fiscal profligacy, more and more government borrowings, and so therefore higher real interest rates in this decade compared to the past. And again, therefore, we are veering more towards, therefore, businesses which have more stable cash flows, as against a greater weight towards, let's say, VC-type businesses which have huge capital needs. So it's all relative, but I think these are factors that are actually shifting or probably having the greatest influence on our portfolio construction today, the result of this geopolitical world and economic fragmentation that we are seeing.
So Karen, obviously, sorry, go ahead, please, Max.
I was curious, one of the types of things you mentioned that were diverging, it was interesting to note that some of those felt good for investors and some of those felt bad for investors. Like, monetary policy being different in different countries leads, that's, I think, on average, good for investors. There's more things moving around. There's more things to trade. We're not all betting just one uniform thing. So, like, some of these things are diversification. Some of these things are just outright bad, like the geopolitical ones and things like that.
So I would agree that when I look at monetary policy, I think in the near term, that probably has a bigger influence on what we are investing in. But if I look at a 3 to 5 year perspective, I think, yes, it's got to be important. But I think some of the other issues I mentioned, geopolitics, we think is going to have a more important impact on our portfolio. So I think that's where we're, and monetary policy is, depending on which market you're looking at, in emerging markets is likely to be more constrained, for example.
Yeah.
Whereas in some other areas, there may be more flexibility.
So Karen, I wonder, from your perspective, we heard geopolitics. We've gone, it seems like, from a world where it was assumed, understood, we wanted to have less barriers to passage of goods, services, people, capital, to one where there are more barriers now across borders. Do you agree with that? And if so, what does that mean for you at Bridgewater?
Like you're saying, I think we've gone to a world where it almost seems desirable to people to see lack of convergence, to see divergence. You talk to businesses and, there's the ups and downs every day of what's happening with the US-China relationship, but they get the direction. They understand that they need to get out of having that much reliance on China, and they're setting up for constantly talking about resilience. Now, what does resilience mean? It basically means you got to double do what you're doing and make it more expensive than it was before, because you weren't in China for no reason. You were in China because it was the cheapest place to be, because that's where you had cheap capital, because that's where you could set up most efficiently. So to go set up a double do, to go create resilience such that if there's a problem, you have a different way of getting your goods or creating them, that's expensive. So I think the biggest implication for investors is that we were kind of in this world where there was like almost a gravitational pull, like all else equal, of inflation to, 0, 1%. And that kind of underpinned a lot of the investment landscape, because it meant that central banks could always be easier than usual because they didn't really have any tension. If there's no inflation, you might as well just be as easy as you can at all times. What's the downside? There's no inflation. And this shift in geopolitics has been one of the really important drivers, kind of smacking us out of that world to a new era where the gravitational pull of inflation is higher, maybe to more like 2%, not a disastrous number, but one where that tension actually starts existing, because you have all this structural spending that people feel they have to do, whatever the price. Some of that is just remilitarization. Without some of these geopolitical pressures, you wouldn't have that. But countries around the world are basically saying, I need to spend more on military activities. Some of it is corporates spending on redoing their supply chain. And the third type I'd mention is everything you're seeing in industrial policy. Officially, it's doing something else. For example, the IRA is going after climate. But I don't believe that spending would have been there without that backdrop of geopolitical competition, and that sense that if China is willing to spend so much state money going after their strategic goals, why aren't we? And so that's a lot of multi-year, doesn't really matter exactly what the price is, government-led, geopolitics-led spending that people are going to do. And the outcome of that, from a perspective of just a more inflationary environment, is probably more important for investors than any one particular, company difference or exactly which supply chain gets rerouted.
Andrew, you have a particular perspective here. I mean, you have a lot of money to invest, but you also are responsible for a lot of pensions, paying people who are retired the money they expect. How do you adjust to higher inflation, as Karen just talked about, it looks like for the foreseeable future, and also higher returns, let's face it, on fixed income? I mean, you're getting real returns now. How does that change your decisions about how to invest the money?
Slowly is the answer. I mean, we're probably more battleship than speedboat. We do have 800,000 participants and beneficiaries that we're thinking about, and somebody ostensibly started it, the state of Virginia today, that we've got to take care of for the next 80 years. So 80 years is not our time horizon, but it's definitely over the foreseeable future, and presumably over some of these, over the horizon of some of these geopolitical tensions, let's hope. We have begun to tilt a little bit more towards fixed income strategies in the portfolio, mainly private, but also, when suddenly interest rates are up off the floor, fixed income does become a viable opportunity. And with equities broadly being as expensive as they are, you have to start thinking about the tension between those two and making some decisions that were sort of one-sided for a very long time.
Rohit, pick up on what Karen talked about interest rates and inflation going forward. What sort of projections do you make about where we're going in longer-term inflation rates? Industries, is there divergence in your analysis, country by country, and how do you incorporate it?
So look, as I said, I think you got to we do believe that we are in a period of structurally higher inflation. Not inflation that's going to be completely out of hand, but as Karen said, whether it's 2%, 3%. So it's a different environment from where we were. So therefore, you need to have assets which actually would benefit from that. So whether it's infrastructure, there would be other areas like commodities, which we traditionally did not look at, and we're being forced to look at to make sure that there's a balance in the portfolio out there. But again, the balance in the portfolio is important because as much as we are all convinced about this structurally higher inflation over the next few years, yes, maybe for the next 3 years, but we don't know the productivity impact that AI is going to have. And maybe in 4 to 5 years, that's an offsetting factor. So, the way I look at it is, look, you can try and, in fact, it's even tough to be correct from a 2-3 year horizon, but I think we feel fairly strongly that we are seeing a structurally high inflation. But as you look forward, there will be different forces at work. So I think what it comes back to is having balance. You can't have your portfolio all geared towards stuff that's going to be high growth, low inflation, or the other way around.
Max, I want to pick up on what I think you were saying, which is in a divergent world, that means there's less correlation by and large. And does that create investment opportunities? Because when it's all correlated, it's a little harder to really make real alpha.
It is, but actually to pick up on what Andrew and what Rohit were saying on inflation, so different monetary policy will lead to less correlation, but inflation has generally speaking, inflation is what causes stocks and bonds to be positively correlated instead of negatively correlated. And we all had 25 years of the two biggest asset classes in the world being negatively correlated, and it's massively important for people's portfolio if they take your two biggest investments and you change them from being negatively correlated to positively correlated. So I think the presence of inflation in a meaningful way and the impact of that on interest rates is all of a sudden creating this just increase in risk. There's kind of nothing good about it if your two main assets go from negatively correlated to positively correlated. And so I think one of the things that if we do have continued inflation, we'll see roll through markets is the continued appreciation of that. Back of the envelope, if you say, I want to have the same utility portfolio that I had before when these things were negatively correlated, but now I want to have it when they're positively correlated, and you just loaded that into interest rates, you'd have to have a several hundred basis point increase in interest rates. You just loaded it into stocks, you'd have to have 30 or 40% lower stocks to have the higher returns go forward to offset this correlation change. Now, I'm not necessarily calling for those things. It wouldn't be loaded into one. It wouldn't necessarily, the markets could also just decide to have a lower utility portfolio. But it is that's a really undesirable convergence, is stocks and bonds becoming correlated. And that is what happens when you have inflation.
Karen, it strikes me when we talk about inflation, there are some exceptions. Japan is still trying to get their inflation up, and that may be less correlated with a lot of other economies. So talk about geographic diversity and basically some uncorrelation across countries and economies.
It's really important to investors to realize that the biggest source of diversification that's fundamental is if you're in actually different locations that have a different economic cycle, different monetary policy, different things going on. And Max talked about this example of the stock-bond correlation. It's such a good example because that is the biggest source of diversification investors relied on, and it's not reliable in certain environments and certain types of worlds like where inflation is prominent. And so when you look at what people's portfolios look like geographically, they're extremely US concentrated. And all you need to do is look at the market cap and just say, what is the market cap of stocks? A lot of people are kind of, invest according to market cap as a starting point. Extremely US concentrated today, more than it has been. Then when you go to private assets, people are more concentrated in private assets. Where do they have deal making capabilities? It's not like they have deal teams on the ground in Japan and India. Most people don't. They're really US concentrated. So the biggest area where you really get large liquid markets and investors don't have a lot of exposure are Asian economies, where you have a really fundamental source of diversification from the fact that they, in large part, places like China, Japan, they can run their own monetary policy. They have much of their own drivers. So you get a fundamental different correlation where it's just a different environment and you're there. The second thing I would add to that is that when you get differences between countries, even if they're relatively similar, but the timing is somewhat different, you start getting currency moves. And currencies are, relative country pricing, and inflation has a very natural relationship because if you have a lot of inflation in one and not in the other, spending power has to shift. And for a long time, investors just didn't have to worry very much about currencies, and you kind of invested not thinking about this question. And it was okay, because if you look at stock performance until recently, the question of whether or not you hedged your currency exposure was kind of a side note. It didn't really drive your performance very much. Very different than what happened in periods where inflation was more volatile, and that was the one thing that mattered. And I've spoken to not a small number of private investors at Milken here that talk about, great investments that then got destroyed by currency moves in places that have had more volatile inflation. So, we were just talking before getting on. The question of which stock market has been performing well really depends on whether or not you've been hedging the currency. Japan has been amazing, an incredible performer, if you've thought about your currency exposure and said, I don't want it. And so that's going to become a more prominent source of returns for investors, and a topic that actually needs to kind of get back on the agenda, because you just look at performance of the Japanese stock market, which, as you said, has been a big diverger in terms of what inflation outcomes are like, the kind of monetary policy they're running. And if you're in Japanese assets, you have to ask yourself the currency question.
I'm curious, actually, Andrew, at Virginia Retirement System, how much are you invested in the United States as opposed to non-U.S.? Because there has been a big pull toward U.S. of investment. That's been the play people have made. It's been dominant. To what extent are you diversified into other geographies?
I think to Karen's point, we're sort of driven by the benchmark and the market cap. So in the equity portfolio, we're, whatever that is, 60% U.S. these days. And just generally kind of float with that. Our strategy when it comes to public equity is kind of globally diversified beta, and then try to add something on top of that. So we're not making region calls, we're not making sector calls. Those are kind of fall out of security selection decisions within some limits. Fixed income is basically 100% domestic. Private markets, which is about half of our portfolio, is dominated by U.S. real estate, credit, private equity. I would say back to the geopolitical concerns. It's we've decided to at least hold for the moment on Asia, because much of the private equity there is kind of driven by China, and we just are uncertain enough about China at the moment that we don't feel like locking up capital for the next 10 years.
Well, let me ask, if I could, Rohit, about China, because, again, I think of you as sort of closer to China than most of us are, geographically. The move from sort of integration with China and the U.S. and the Western economies toward whatever you want to call it, de-risking or whatever euphemism you want to use, has it changed your portfolio fundamentally?
So look, China is a large part of our portfolio. It's almost 20% of our underlying exposure. About half of that is direct investments we've made, and half is actually our portfolio companies that have invested in China, so the look-through exposure. So it's not something that we can change overnight. But the attractiveness of China on a relative basis clearly has changed. We don't think that it's right to sort of not be in China at all. There will be areas within China, like I mentioned, the domestic areas which should be attractive. But there are a lot of structural changes. I think decoupling is for real. And there are sectors that we would have invested in earlier, for example, in contract research or contract manufacturing organizations for global pharma companies, where the argument was there is no choice. They have to go to these companies because there's no alternative available. I mean, today, the values of those companies are crashing because people are saying, yes, there may be no alternative for the next 2 years, but on a 5-year perspective, people will find alternatives, so the terminal value of those companies has dropped dramatically. So structurally, I think China has changed. Growth is clearly slower, nominal growth even much lower than what you had earlier. That is an implication of overall earnings growth. You also have today a situation where there's a crisis of consumer confidence because their biggest asset, which is real estate, 60 to 70% of their wealth, prices there are falling, and they don't have jobs. Corporates are not hiring because they've seen their stock prices halve in the last 3 years, and frankly, some of them are concerned about regulation and their personal security. And investors are not confident because of all the geopolitical issues we're seeing. So really the solution's got to be getting consumer confidence back in China, because domestic savings is a big pool. And that, like we've seen in India, can actually drive the market. So, and it should happen sometime. I think the leadership is conscious of the fact that that needs to change. I don't know whether it happens in 1 year, 6 months, or 3 years. But because of that, the diversification is important, to have some presence out there. I mean, classic example, I mean, this year, China's in US dollar terms, on an unhedged basis, the best performing major market. All in the last 2 weeks has that happened. So I do think, look, there are segments in China which will be attractive. But from an overall perspective, I think you've got to be more cautious than you were in the past. And therefore, that impacts the weightage that you put out there.
Karen, Bridgewater has been thought of in terms of China for some time. You have a long history there. And when you were talking about Asia, I don't think you mentioned India. So I'm curious about China with respect to India, and for that matter, other places like Vietnam and Indonesia, as foreign direct investment has seemed to fall in China. How do you assess India as an alternative to China, and for that matter, Indonesia, other Asian countries?
I think India is fascinating. It is still meaningfully smaller than China, as just kind of what the markets are like, and more difficult than China to transact in. So if you look at China, I don't know, 7 years ago or something, it was very difficult for a global player to practically be in China. And so even if you weren't worried at all about geopolitics, about them confiscating your assets or anything, just logistically, the question of like, how do you buy a bond or how do you buy a stock was a challenging one to work through. And now a lot of that shifted and it's significantly easier, though it's obviously still harder to buy a Chinese asset. I shouldn't say obvious, they could have made it easier, but still easier to buy a Chinese, hard to buy a Chinese asset than say a European asset, but a lot of barriers have come down. So today, China is accessible. You can, as a global investor, build up a relatively meaningful allocation if you want to, and you'll get this like extremely uncorrelated exposure that, in my view, even with pretty disastrous outcomes in China, may have reasonable return because the pricing is just so pessimistic because so many people have left and it's so hard to get people to invest there. In India, even if you're very, very bullish, the structural challenges of literally getting exposure are just going to make it more difficult. You just can't build up as big of a position. So my view is that if you want geographic diversification, China is kind of a thing all on its own. Lots of people have their own kind of structural challenges, regulatory challenges, political challenges, governance challenges in being in China, but it's definitely the most diversifying thing you can have. If you want diversity except for that, I would say you're better off being in sort of a basket of Asian countries, not over-concentrating just on a place like India, because you'll struggle to get a meaningful enough position and enough diversification. You get overly idiosyncratic quickly and up to too many rules and regulations that are local. But once you start aggregating across the markets in Asia, then you start getting a pretty meaningful allocation that you don't have to know exactly which country will benefit from the shift in FDI, and kind of as a block of countries has somewhat of an uncorrelated set of economic circumstances and can give some pretty good diversification.
If I could just make a point on that on India. We've been there 20 years on the ground, and I would say we're more excited about India now than we've ever been in the past. So just for context, in terms of our direct investments, so not to look through from our portfolio companies, our exposure in India now is about 50% of that of China, which is actually quite high in the context of relative size of the economies. And it's doubled in the last 3 years, and I can see it go up by at least 50% in the next 3. And we are finding significant opportunities. So it is actually becoming, given all the constraints there may be for people who are not familiar with India, but if you are, and it is possible to sort of meaningfully build exposure there right now. And we like it particularly because it's a large domestic market, which for all the reasons I mentioned in the geopolitical world we're talking about is important. But also it's the one large market that could be a major beneficiary of the China +1 diversification. Vietnam and all are being short-term beneficiaries, but they have a size constraint. India has issues in getting manufacturing right. They're moving in the right direction, but the potential there is significant. So I would say India is one of our top markets to look at in Asia today. And of course there's China, there's Japan, and some parts of other North Asia.
Max, I want to come back to you on the question of currency exchange and hedging. Is it a larger factor going forward than it has been in the past? And how do you do it? How expensive is it?
So, I wanted to build off what some stuff Karen was saying on that when she was talking about the currency volatility being a thing now. And one of the things we find really interesting is when, I think there's, some agreement on the panel that divergence is a thing that's happening in various contexts, and you look at where that is what financial markets are also saying and where it's not. And, you might be able to find opportunities where you can disagree with it. And I think FX options and FX volatility right now is, in fact, I agree with Karen fundamentally. There's lots of stuff going on that should lead to currency volatility. But dollar-yen aside, we have, in fact, very low levels of currency volatility, both realized and implied. We're talking about China and India. China is a 3-vol currency. India is a 2-vol currency. These are, almost, verging on pegged. And so I think there's an opportunity there to actually get cheap protection against what, I would agree, would be some possibly interesting moves. Now, it can play out different ways. You can actually, it turned out, have a currency be just more volatile than it's priced in markets. But it could also play out a different way, in the case of China and India, where they are quasi-managed currencies. You could have the situation where, economically, fundamentally, it could be that the right price for the currency one year is 15% different than it was the previous year. But if you're going to move in a low volatility way and you have to travel a long way to get to the right fundamental level, you've got a trend to get there. So it might be volatility, it might be trends in the market. I think both those will probably be above average places to be. But I think right now it's this really interesting combination of, there are a lot of reasons to think that there should be volatility from these things, and yet that's not how the market, again, dollar-yen aside, that's not how the market is pricing it.
Well, let me come back to dollar-yen aside, which is a big aside, but put that aside, Karen. Do you agree there's less volatility than you expect? And how much of that is because the world is essentially pricing off the Fed? Everybody's just waiting for the Fed.
If you look at what pricing has been like, we've gotten a lot of questions over the last, year of, has the world just gotten smarter and you're going to get less volatility because the Fed just gives such detailed guidance? You can really know what's going to happen next. There's good reasons why people can kind of see the future better. My strong read on that is absolutely not. We're making as big mistakes as ever. And if you look at after the fact, how wrong were markets, they have not gotten any more right than they have been. And so I wonder if there's almost a false sense of confidence that's gotten created by a lot of signaling, a lot of direction, dot plots, a lot of communication. But when you actually go back and look at the last few years, you're there's been lots of mispricings and predictions of the world that didn't work out the way that markets had originally priced before. And I mostly think that what you really have as a backdrop is that every institutional investor here has had an allocation that's been absolutely incredible over the period of the 2010s. It was the best 10 years to be an institutional investor ever, because it didn't matter. You didn't have to have almost any skill in selecting alpha managers, nothing. As long as you held something reasonably close to market cap, you did great. Right? Stocks were extremely consistent. The US outperformed everything. You had that exposure, you did great. And in addition to that, every time you had a little murmur, inflation wasn't that big of a deal, as Max was saying. So it was very quick for the Fed to come in and kind of solve your problems. And the one asset you had to diversify, bonds, did pretty well for you. And so I think we're just kind of coming out of this period of complacency, if you will. And you talk to people here and people realize, when I got into these positions, pricing was different, right? This wasn't all, if you look at what pricing was like coming out of the financial crisis, you had a disastrous decade of a huge stock market bubble and then the financial crisis, so these kind of twin crises. You came in with lots of room to run and very attractive valuations, and you kind of let the growth run for a very long period of time without running into constraints. Clearly not where we are today. So there's a realization that portfolios that did really, really well less likely to just kind of do well without any intervention, without any ability to kind of influence them going forward. But that's not sort of fully in people's actions yet. And my guess is some of the big allocation shifts are still ahead of us.
How much did the portfolios do well just because money was free?
Oh, I mean, money free underpins a lot of things, right?
I mean, were we lucky or were we smart?
We were definitely lucky. I mean, I'd say we were smart in terms of the Fed and other central banks put in place good policies. The economy needed this period of, kind of, I mean, you had tremendously dampened volatility for a long period of time, very few kind of macro alpha opportunities. By design, by engineering. It was like, we need this period to let deleveraging happen. You let debts come down. You kind of had this period that we really needed. So it was wise policy to make that happen. But we're not in that world anymore. It's not wise policy to just sort of let things run no matter what at this point.
One of the things that was mentioned by, I think, both Rohit and Karen at the beginning was in industrial policy. That may be one place where a lot of the world is converging, not diverging. It seems like the governments want to get into the game. They don't want to just be the ref. They want to play in the game increasingly. So, Andrew, let me start with you. Do you see that as a significant issue for investors going forward? As we see, I mean, we all pointed our finger at China about how active they were in industrial policy. It looks like in some ways the United States is sort of trying to catch up in some places, and Europe is maybe a little envious right now and maybe trying to move that direction. Does that make a difference as an investor?
I think it has to, but is it a large difference? I would say for us, probably not. It's something that we're obviously spending way more time thinking about than 5 years ago. But is it leading to radically different decisions? I don't think so. I think ultimately, the growth in economies, whether it's driven by industrial policy or underlying organic growth, is kind of what we're investing in the long run. But we have to be more, we spend a lot more time talking about the politics of industrial policy now than we probably ever have. I don't think it's making a big difference, but it's definitely adding a thumb to the scale in ways that it hasn't in the past.
Rohit, what do you think about that? Is it a matter of friction? We talk about it a lot, we get upset about one another, but it's not big enough to really drive an economy as opposed to monetary policy or other factors?
Actually, it does make a difference in investment decisions. Now, in some cases, like if you take the US IRA, we won't make an investment because of it, because things could change, but that it'll be an additional tailwind if this sort of continues. In some other areas, actually, it has the reverse impact. Let's say in China. I mean, traditionally, the philosophy in China was invest in policy-aligned sectors with the government, and you will do well. Today, the policy-aligned sectors are all these clean energy sectors, but because they want them to be competitive, there's so much capital going there that you're creating overcapacity out there. So even though they are world-class companies, they're having weakening margins, and you don't see that earnings growth out there. So actually, it is complicating things, and in some sense, you obviously have to be cognizant of where government policy is going, but you won't necessarily just invest alongside it. In fact, in some cases, you may have to stay away from it for the reasons I mentioned.
Max, one of the things investors like is some predictability, some stability, and as governments get more involved, and this can be true in China, you've seen this in China, some places where they back things and then decided not to, and similarly in the United States, who knows what happens politically here, even with the IRA and implementation, depending on the elections. Does it increase more volatility because you're not quite sure what the rules of the game are if the government is playing a substantial role?
It can, sure. For us, it's not productive volatility. Like sometimes things happen where those are in spaces where we have, we think useful opinions on. If it is like whether the IRA will get, repealed in a couple of years or not, that's not an area of expertise for ours. So then our focus goes into, making sure that we have a portfolio that's okay with both outcomes. And in general, that's a big part of the art here. But I would say yes to volatility, but for us at least, once it gets into things like, which way political decisions are being made, it is. I'm not going to say anything useful on that.
Yeah, Karen.
If I could just build on that, we have a process where we kind of create a map of all the different geopolitical and regulatory issues that are sort of on the horizon you should be aware of as an investor, right? And we create that both qualitatively and quantitatively, looking at things like you could see in the options markets, there's some issue at some period in some market. And you take that map, and then we basically, it goes without saying probably that that list is a lot longer than it was some number of years ago, and much richer because so much is happening. But you take that map, and we basically map it against two things. One is basically how big is this relative to your portfolio? So if you're talking about like an election in Thailand, it's probably not very big. But the other one is this like a one-time event or more of a dynamic? Something's going to take a long time to play out. And I think that kind of mapping helps you know what to go do about it. The more you're talking about something small and something that's like a one-time event, the more I would think about it as an investor more like something you just want to control risk for. And so I don't want to be in a situation where I'm trying to bet on who's going to win the US election. And so if I think something is like, well, either it'll happen or it won't, it's 50-50 chance, I'm not the one who's going to go figure that out. I really just want to know how big is my portfolio exposure, how many losses am I willing to take if it goes the way A versus way B? Can I just kind of get out of the way on something where I'm not going to be the one predicting it? The more it's a big deal and the more it's an overtime dynamic, the more it is really worth your time as an investor, in my view, to be studying the cause-effect relationships, trying to understand how it'll play out, and potentially getting ahead of it. Because you're not sort of saying, will they, won't they? You're actually saying, this is a dynamic that's going to matter in markets, and try to think cleverly about what's already in the price of the market versus not. So if you think about the US election as an example of that, I definitely don't want to be in the business of betting on who's going to win. That said, I think certain dynamics, they'd be maybe exacerbated under a Trump presidency, but probably will happen either way. So issues like, will there be more trade barriers? It seems to me like there's a lot of bipartisan agreement on that issue. So maybe Trump will accelerate it further, but it's not like you're saying, well, if Trump loses, don't worry, that issue's off the table. I just shouldn't worry anymore about trade issues. And so that's where it's really worth your time to start thinking about, as more trade barriers go up, what happens to the dollar? I think it's pretty dollar bullish. And what's the pricing in the markets today? If you look at companies that are sensitive versus not, is it already incorporated in their price? And that's where you can actually find opportunities.
Well, just to pursue that, if I could, Karen, do you literally plan out scenarios? I mean, for example, it looks like right now either Joe Biden or Donald Trump is likely to be the president. There will be some places, as you say, it doesn't look like there'll be a lot of difference we can tell, like tariffs, for example. And perhaps fiscal policy, too. I'm not sure if we're going to pay off the deficit under either one of them, the way it's going right now. But there are some places where it looks like there will be difference. Do you plan out scenarios so you make sure you sort of stress test your portfolio to say, okay, if Biden wins, this is what happens. If Trump wins, this is what happens, to make sure that we're protected either way?
Yeah, that's exactly the process. And the question of how to do that gets very tricky in a case like this election. So if you take something a couple years back like Brexit, you could really just look at market pricing as the kind of polls moved around and see pretty directly between your logic of understanding what Brexit is and seeing what the markets were doing. We had like pretty good quantitative numbers that would say, okay, if Brexit passes, this is what this market is likely to do. I'm not saying they were literally perfect, but you had a pretty good direction, so you could really think about risk controls. In a case like Trump-Biden, you're in a more open-ended world where what you're trying to do is really say, well, what do they said about their policies? How likely is it that's the policies they'll actually do? Are those policies already in the marketplace or not? And there's a whole bunch of policies. And so depending on what assets you're talking about, those assets may be very sensitive to just policies around climate or just policies around industrial competition with China. And so you have this more complex process of translating from the person winning to what they're actually likely to do, where there's a lot of errors you could make in what they're actually likely to do, to then going to assets and seeing how it'll hit them. But I think there's no choice as an investor but to basically do some version of that process to figure out what's my exposure, because most investors I know don't want to be in a situation where they're betting on one outcome or another here.
Rohit, I assume at Temasek you do Sorry, please, Max.
Like it's kind of incredible how vague the factor is and how changing. Like if you try to define a risk factor for the election victor this time, it's like crazy impossible. Like for the reasons that Karen was mentioning, but also even like if you look at the last time the 2016 election, like if there was one thing that was clear leading up to it, there was a risk factor that, when Trump's odds increased, you had, stock futures went down and the opposite. And that lasted for about 6 hours after the election. And so on top of all the things Karen mentioned about, like, we actually don't know what the policies are going to be. They might change their mind. They might get through. They might be in the price. It's just like, there's so, like, we try to think through it, but I think there's a limit to what you can get with trying to think through it very specifically, because there's just so much unknown. And so I think a lot of it, you start retreating to, like, seeking general resilience in a portfolio, as opposed to, you want to make as good a guess as you can as to what the various exposures are, but I think there's kind of a limit to what you can get in many specific scenario analyses.
Take us through what you do at Temasek, because we're talking about a presidential election, which is important, but it's not like a war. And the end of history was predicted a little too early, it turns out. Now we have a war in Europe, we have a war essentially in Gaza as well, we have potential conflict in Asia, we hope not to, but the South China Sea doesn't seem like it's getting more Pacific, as it were. So how do you anticipate that? Because markets traditionally, I think, have a tough time really discounting geopolitical issues of that magnitude.
So again, as I mentioned, because so much of our portfolio is illiquid, it's really important for us to do the scenario analysis and trying to think through, are we going to be particularly exposed to one scenario versus others out there? So even, from a very short-term perspective, take the US elections, right? We don't know, but we do know that, for example, right now, cyclically, we're more constructive on Europe because we see rates coming down, we see the economy having bottomed and recovering from a low base. But if in a Trump win, potentially Europe could be hit badly in terms of tariffs, firstly. If there is an attempt towards forcing them to spend more on NATO commitments, taking away from their fiscal flexibility, all these things are going to sort of impact the equity risk premium in Europe. And so that is something that you've got to keep in mind, and then look to see as to what sectors out there, for example, are likely to be, or what companies are going to be more exposed to that. On a longer term perspective, the wars that you talked about, let's say things in the Middle East. If you look at it, in most situations, the channel through the impact will be oil prices, and therefore you look to see what situations you could have out there and how it would impact our portfolio. And then in Asia, for example, if you talk about Taiwan and China, now clearly there's a scenario if you have a full-fledged war and TSMC gets blown up, I don't think you can protect yourself anywhere, at least on the equity side, which is what our mandate is. Probably go to fixed income that side. But if you have situations around economic blockades and therefore more sanctions on China, etc., you got to think as to what are the things that you know will happen, maybe around currencies, maybe around certain other capital controls. And how do you sort of manage your exposure there? For example, the traditional way of thinking would have been you're better off investing in ADRs because you can exit them quickly as against in A shares in China. But actually, in that sort of scenario, you could have a forced delisting of ADRs, and you actually might be better off in A shares in China. So we try and think through different scenarios, and you can't protect against everything, but you've got to sort of try and see as to how you don't want to be completely hit really badly in one scenario, and at least then you can survive that period. Because the two things we look at, one is what is short-term impact, and then the other one is what we look at is permanent impairment, which is on a free cash flow perspective. And for us, the latter is more important. So can we survive? Can we make sure that at least that permanent impact is mitigated the way our portfolio is constructed?
Andrew, as you said, you have a longer time horizon, if not 80 years, at least quite a few years looking out. So you're, I assume, not as much worried about what happens in the election this November. But what are the longer term issues that you might scenario plan for?
Sorry, it's a question to me?
No, for Andrew.
Oh, sorry.
Yeah, we've spent a lot of time on, is China investable? Like, I know there are other public funds that are getting political pressure on China. We're really not getting political pressure on China, but we're still trying to make the decision, is this an investable market for us? And I know that, the sort of default academic answer is you should invest in the broadest opportunity set, and it's in the benchmark, and therefore it's investable. And I say, well, benchmark providers don't know anything about VRS and about what our goals are. So we've sort of tried to go back and reprove to ourselves whether or not that is investable or not. Talking about this, it dawns on me that the process that we're all using is identifying a risk, right? Seeing what the potential outcomes are. I would say, does it matter? And then the the next question is, can you even do anything about it? And for us, with half of our portfolio in private capital, and with the rest of it managed the way that it is, there's not much that we could really build into sort of scenario planning about the US election. Maybe we can make some changes around the edge about China. So, is it practical for us to take a position one way or the other? And what's our conviction level? And so far, I would say we have maybe made modest changes around the edges or for anything, but I think it's more like, what are the opportunities in the marketplace that are being presented to us rather than what's the geopolitical risk that we're trying to mitigate?
Karen, Andrew raises, I think, an interesting question about private investment. It's been around for a while. It's not a brand new thing, but boy, it seems to be growing. And I'm talking about private credit as well as private equity. How is that shift affecting portfolios? Does it affect a portfolio? As more and more of our companies are private, they're not public, as more and more of the debt is private debt, not publicly traded, how does it affect a portfolio manager, if it does?
Well, look, one of the big questions that I have from a very macro perspective is, with more and more of the net new credit happening in private markets, how much more opaque is the credit system becoming to somebody kind of looking and studying it from our vantage point? Like, historically, it's been very easy to see how much credit is being created. Very, very quickly, you can tell how much loans, how much bonds are being issued, and at what price and terms. Very, very quickly. And the more credit's private, the more you just don't know. You don't know exactly what terms are being offered. You don't know if they're lending or not lending. It just, more of the credit system is more opaque. Now, this may be a worry that doesn't really materialize into that much, because if you look at the amount of private debt out there, it's very small relative to all the debt. It was really just a period where a lot of the net new debt was happening this way. But there's a lot of signs that it's turning back the other way, that the banks are kind of coming back in and saying, wait, you're eating our lunch. Like, we're not that interested in totally losing market share to all of you. But we still don't know, and we've never had a major loss cycle with a lot of debts being in this kind of format. And so we're going to learn a lot as that kind of materializes for folks like us that are not in those private markets, but more studying the broad macroeconomy and understanding how the credit cycles are working. We're trying to figure out whether we know less than we used to from the fact that more is happening sort of in an area that is just not as transparent. Even if you're active in it, you're seeing the little part you're active in. No one can kind of see it at a bird's eye the way that you could with corporate bonds and bank loans.
Max, what about the, I'll call it a private curtain being pulled over, some capital allocation now? Does it affect you?
Actually, that was me.
Yeah.
I think, I mean, you can never say no to a question like that, but I think directionally, like, some of the changes seem bigger than they are. Like, private credit has grown a ton, but like, how much of that is from public credit versus from bank loans and things like that? It's the change in sort of things with QSIPs is not as large as the growth in private credit. And there are different transparency to your average private credit fund than to a bank's portfolio, but neither of them are completely transparent. And so I think, all of the things being equal, yes, more stuff getting shrouded right. is a risk factor for markets and that we need to be aware of. But I sometimes feel like it's the actual shift has not been that huge.
So, Rohit, let me ask about a point of perhaps convergence, at least for much of the world. We're talking about divergence, but convergence, and that is growth of population. I mean, apart from perhaps Africa, as we look around the world, birth rates are declining. Populations are not growing at the same rate. There are projections it'll level off sometime later in this century. When you look at longer-term trends that you need to take into account as an investor, Rohit, how do you take that into account?
So I think from the perspective of the investment horizon we're looking at, I tend to look at it less from a global perspective, but more in individual markets. So for example, in China, you're going to see that shift happening in terms of demographics over the next 5 to 10 years. So that becomes relevant for us to think through the implications of that. There are other areas where, in India, yes, you got population growth slowing, but it's still carrying on and probably will slow from here. But the impact of that slowing population growth is probably going to be over decades, not over the next 5 to 10 years. So not really that much in our investment horizon. So to be honest, it's something that we look at, but more in the context, I mean, right now, maybe in the context of China, in the context of Japan, people have always looked at it, but we've been less focused on it otherwise as such.
Same question I'd ask you, Andrew. Do you take into account demographic trends over time?
It was definitely, with respect to China, it was definitely part of that exercise. Is this investable? I mean, I think there's two parts to that question, like the geopolitical question, but also is the investment opportunity the same that it was, say, 10 years ago? We do think about it, but it's probably not something that, because of the size of the U.S. and how dominant it is in our portfolio, we're not thinking about demographics really all that much outside of the U.S. as a driver of portfolio construction.
We probably think about it a little more in terms of aging populations and in terms of what segments that could actually create demand for. So from that investment lens, we look at it more from that lens rather than what it does to the overall macros and most of the markets that we're operating in. I know Karen had some views on Africa.
Well, we have this partnership with the World Bank that we're really excited about, where as they're trying to raise money for IDA, which is kind of one of their vehicles to really put money into sub-Saharan Africa, we're their partner on the private side doing macroeconomic research on the region to support that. And when my team started showing me the demographic numbers, I literally was like, please go back and let's make sure we're not messing up the analysis. Because, I mean, look, that's what compounding is like, but the numbers are staggering. That if things go the path we think they're going to go, something like a quarter of the world's working age population is going to be in sub-Saharan Africa relatively soon, not in some super far away future. And when you look at just how slow the productivity growth there has been, it's a different world having that much of the world's population be somewhere that is quite poor and kind of not coming out of poverty. It's not really a region that most investors have a whole lot of exposure to. So I do think that the more pressing investor question in the near term is going to be, how much does it matter when population shrinks quickly? And is there kind of a turning point where it does have big macroeconomic impacts? What I will say on that is that despite the fact that Japan has been living with this for a while, I don't think most investors have a clear map of, if that's what you know about a place, what does that mean? It's certainly a topic that we're actively studying and thinking about, and what in the Japan case teaches us versus what's actually not that instructive, because we know that's what the future is going to look like in the big markets that we are in. Yeah,
it's interesting in Japan. Like you mentioned, we're converging demographically, Africa aside, but it feels like we're all traveling the same road, but we're at different spots on that road. And Japan got there first, Korea and China are out on that end too, and then Europe and the US behind. And the things that you can kind of learn from the countries that have been getting there first, and the sometimes inconsistencies in the way markets react. One of the things that I'm thinking about in markets right now is Japan versus Korea, which are demographically very similar. The birth rates are nearly identical, and yet, that should, generally speaking, drive down real rates. And, yet in this last few years, you've seen Japan respond almost not at all to that, and Korea respond like most of the other countries in the world, where they did have more of a spurt of inflation, but the question is, in the long run, will the demographics bring that back down? So we think Korea got mispriced because it was following the little burst of inflation, but the drag of demographics are going to pull it back down. And so we do spend a lot of time thinking about demographics and where sometimes short-term flows pull things away from the demographics. So that's pretty relevant to our process.
So in the 5 minutes we have left here, it strikes me we've had this entire conversation and have not talked about climate at all. I'm not sure that's a divergence point, maybe a convergence point, as the entire planet seems to be going in the same direction, but it has to be a risk factor in longer term investments. So Rohit, let me start with you. How do you take into account climate, what's going on with climate, what might go on in terms of actions by governments to try to address it?
So governments, it varies across, China's taking a lot of efforts to address it, Europe's taking stuff, and the US has approached it differently through the IRA. But from our perspective, we clearly see that there's going to be a cost to a carbon footprint. There has to be in some form or the other. Already is there in some places, but will be more widespread. So for portfolio resilience, that's a pretty important thing that we have to focus on. And we set a goal for ourselves in 2020 to reduce the carbon footprint that we had for our portfolio by 50% from 2010 levels by 2030, which effectively meant reducing our footprint by 2/3 between 2020 and 2030. And it's really forced us to rethink how our various portfolio companies are performing and what they need to do with their portfolio. Secondly, what we've done is that for every new investment, we put a notional carbon price. It used to be $42 a ton. It's today $65 a ton of CO2. And we use that to simulate what the impact on the company would be. We use that to have a higher hurdle rate for investments. So it is something that every team is now actively looking at. And we built models to see it dynamically also. There'll be some sectors where you may have a carbon price, but you can pass it on to consumers, and others you can't. So what will really be the impact on you? So it's front and center. We think it's critical for the portfolio from a risk perspective. But equally, we are seeing it also becoming now a big source of opportunity. And it's, again, I would say, a very small percentage of our portfolio is on climate-aligned new opportunities, but it's probably the fastest growing segment of our portfolio today.
So Andrew, same thing for Virginia. I mean, risk and opportunity from climate.
It is something that we consider when we're making an investment, but I would say it's not in the top 10 at the moment. But I think that there have been some opportunities created where we recognize that climate transition is going to take a long time, and it's still going to take fossil fuels to get there, where there's been forced sellers of fossil fuel exposure, where we've been able to sort of take advantage of what we think of as attractive pricing there that still fits within sort of the climate transition timeline that we foresee.
Max?
I think, probably in a investing sense, we're most active in the energy transition portion of climate change. I think we were almost going to get through a whole session without talking much about AI, but AI is an important driver of energy demand go forward. And so, I don't have as in many things, we're mostly trying to make sure we're resilient to a lot of different outcomes as opposed to having a super specific prediction. But it is, there's a lot of interesting stuff happening. There's, natural gas market is trying to figure out how to be a global market. The U.S. is trying to figure out how to, actually move electricity around in ways we haven't had demand growth in many decades. I do think that there is there's all the, alternative energy sources that have been increasingly prominent. So there's a ton of stuff to do. In terms of longer term, what will this look like 2 decades from now? I think that's a little, that's something we think about from a risk perspective, but I would say that's not a big influence on our current portfolio.
So Max teed it up for you, Karen, AI.
Oh, wow. I was going to talk about climate. I will say that AI, if you asked me in January, I would say every secular force is inflationary, and the one big deflationary question mark is AI, which obviously could be a huge deflationary event and displace a very large share of workers in the economy, especially more white-collar workers. And this could become, the biggest multi-decade event since what we just went through in the manufacturing sector, where we kind of replaced a lot of the workers with a mix of robots and outsourcing them. Today, I would answer that a little differently and say, look, that's still the future of where AI is going, but it feels more like a phase 2. Phase 1 of AI feels like another inflationary force to me that just gets added to all the other inflationary forces. Phase 1 of AI really feels like every major company feeling like they have to spend regardless of the price in order to keep up with AI. Obviously, with the big tech companies feeling like it's existential and we'll pay whatever it is we need to get the electricity we need, get the chips we need, and basically put whatever we can into this. But there's no company, you can't imagine a large company CEO that's not currently investing and figuring out how AI could help his business. If he or she are not doing that, their board is going to throw them out. They're going to have to. And so in the near term, it feels like yet another very inflationary, have to spend no matter what force. It'll probably transition to be a very deflationary force eventually.
Okay, we're going to leave it there. Andrew, Karen, Rohit, and Max, thank you very much. It was really great. Thank you.
Thank you.
Thanks, everybody.